What's up guys, Jeffrey Rodriguez here, and in today's video we're going to be talking about breaks of market structure, and we're really going to clearly define what a break of market structure is. That way we can align ourselves with the higher time frame before dropping down to the lower time frames. So with that being said guys, before jumping into the video, make sure to hit that subscribe button and that notification bell icon, that way you never miss a video when I upload. Alright guys, so jumping right into this, I want to talk about this GBP USD on the hourly chart between October 2nd and October 5th. So this is something that one of my premium group members had sent me in a question, and he was asking, when I'm looking at this chart here on an hourly basis, why would this down move here not be a break in market structure because it broke below this low? Well, the key thing here is making sure that you're always aligning yourself with the daily market structure, right? So we never want to start on an hourly. That goes for if you're trading, that goes if you're back testing, anything that you're doing in the charts, you always want to start with a higher time frame first, and then you drop down to the lower time frames. So with that being said, let's go out to the daily and let's really get the perspective of, this market and the overall structure of this market so we know what to look for. So if we look and we scroll out, so this market has obviously been on a relatively large downtrend, right? So we've had consistent lower lows, lower highs, lower lows, lower highs, lower lows, all the way down, right? And then we get to a point here where we form a low and then we come up, break above this previous high. So we've got a daily break in market structure here. Why is it a daily break in market structure? It's only a daily break in market structure if the daily chart breaks above a previous swing high that was a previous lower high. So right here, this was a previous lower high, and then we came down and made a lower low. Then the market pushes up, creating a higher high here in comparison to this high that was back here. So the fact that we've come above this high on a daily chart, then we come back down and retest the down candle, which is an ICT bullish order block, and then we get more bullish momentum. Okay, so anytime that we see the market do this little move right here, breaking above a previous daily high in an overall downtrend, that's your break in market structure right here, because we've got a higher high. So you're not looking to buy right here on this trade down into this level. You can do that as a swing position, but that's not where I would be buying. Okay, so I would see this and then I would wait for this. That gives me the confirmation that this market is overall bullish now. We've got a low, we've got a high, we've got a higher low, then we've got a higher high. Then we have 4 consecutive down days here. Notice the bodies of the candles though. The wicks do go through this down candle a bit, but overall the bodies of the candles are staying within the body of the previous down candle, which is an ICT bullish order block on a daily basis. So these 4 down candles, once the market closes above it with this candle here, that validates these 4 down candles as a daily ICT bullish order block. So at that point, what we need to do is make sure we have our high, which is the high of the 4 candles. So we mark out the high, and that comes in at 28.75. So you would adjust that on your charts. And after you mark out the high of the ICT bullish order block, you want to mark out the open. And then the open would be here. And then the last thing is the 50% level of the ICT bullish order block. The reason that you want to use the 50% level is because that is typically your level where you're going to switch your bias. So what does that mean? If we're above this 50% level on a daily basis, this market should remain bullish. If we get below this 50% level on a daily basis, this market will more than likely move back to a bearish trend. Okay? This is all based off the daily chart. So I'm going to delete these 2 levels here because they're not really needed for this particular teaching, but anytime that you're identifying daily ICT bullish order blocks, there are 3 levels you want to mark out: the high, the open, and also the 50% level. If you're using ICT bearish order blocks, you're still going to mark out 3 levels, but they're going to be the low, the close, and then the 50% level. Okay, because bearish candles are obviously inverse from a bullish candle. So I took my fib and I drew my fib from the body of this candle to the body of this candle. So I use the open here and then the close here. Because if you look at this on a 4-day chart, this is a 1-day chart, but on a 4-day chart, if there was a 4-day chart, this would be one down candle because it's 4 consecutive down days. Then we have some bullish days after. We have to wait for the bullish candle on a daily basis to close above the ICT bullish order block to confirm it as an ICT bullish order block. Okay, so I only use the fib to mark out the 50% level. That's it. So I'm going to remove the fib now, and then we're going to go back and we're going to dial in on a 1-hour time frame what we see happening around these levels. Okay, so we're going to drop down to a 1 hour, and then I'm going to scroll back to that piece of price action, which again is October 2nd to October 5th. All right, so here we go. Market is trading down, right? We've got high, low, lower high, lower low, lower high, lower low. So we already seen the daily break in market structure, right? And that was back here. So we've already seen it here. This was this move up, came back down, retest, right? That's why it's so important to have your daily levels, because you would not see this big down move or this up move as a break in market structure on a 1-hour basis. If you have more experience, you may, but it's always good to start with a daily, because that will give you exactly what you need to be looking for on the lower time frames. And then by exactly what you're looking for, you could see clearly we break above it, consolidate right on the level, and boom, explode up again. Dip into it, push up. Dip into it, push up. Okay? So that's why it's good to have the daily levels on your chart so they can be transposed to the lower time frames. But now let's talk about the price action between the 2nd of October to the 5th of October. One of the premium group members asked me, why is this down move here not a break in market structure because it broke below this low? It's not a break in market structure because from the daily perspective, you guys already know that we're bullish because we've already had a daily break in market structure. So this little 1-hour downtrend does not matter. We're anticipating this 1-hour downtrend to trade into our daily support, which is what level? The daily bullish order block 50% level, which is this blue line. So notice what the market does. It comes down initially, but it doesn't hit the level. Comes all the way back up, accumulates some more orders, sells off, drops right into the 50% level. Notice how we consolidate a bit. So the first opportunity to be a buyer would have been here at this level. The reason you would have been a buyer there is because it's based off of the daily level and we've traded into it on a 1-hour basis. Now that would be more of a swing trader's position because you're going to have a larger stop, which would have to be below the daily order block, because you don't have any confirmation in this area proving to you that price is going to go higher yet. Now if you look, we push all the way up, and here is where you can see the break of market structure on an hourly basis. So the market again was in a 1-hour downtrend. We're pushing down. Then we come all the way up and close above this previous lower high point, making a higher high, coming off of the daily level, daily support. Then the market trades back down. This is a buying opportunity. This is a buying opportunity. And you're probably wondering, why are these buying opportunities? Well, number one reason is because we've already broken market structure on a daily basis. Now we've broken market structure on a hourly basis. So this little down move could have been your buy, and you're probably asking, where would I have bought it at? How would I have known to buy it here? You would have simply bought it on the break of market structure. So once the market closed above here, any trade back down at this level here, which comes in at 1.3020, that would be your entry. So yeah, you may sit through, whatever this is, 20 pips worth of drawdown. Okay? This is what you have to expect when you're trading based off of a daily perspective, you're going to have a little bit, larger stop, and your targets will obviously be bigger as well. So in this particular scenario, if you were a buyer here, your stop loss has to go where? Below this low. Okay? Versus if you were a buyer here, your stop loss has to go way back here, below this low. Because this is the daily order block low. This is the 50% level, this is the low. So you would have a stop loss below this low if you bought it at this low, which is 140 pips. That's, again, for swing traders. I don't typically do that. I'm only looking to risk like 20, 30 pips with my trades. So I'm not really looking for anything that extravagant. But for those of you that are looking to trade longer term and things like that, that's how you would do it. Now let's really talk about the entry opportunities, how I would have got positioned, and where the possible entries are. So every red up arrow that you see is a potential buying opportunity. Okay, so now I'm going to go into detail why they are all buying opportunities and how I would have played it, and in my opinion, what the best opportunity for a buy would have been. So could have been a buyer here on the retest of the break of market structure, or if you missed it here, you could have been a buyer on this retest here of this break of market structure. So don't think that I'm saying, oh, you're going to buy this low, you're going to buy this low. You'll never get, maybe you will, but you won't get it every single time. You're not going to get the exact low or the exact high. Like, it's just, you don't need to worry about that. Obviously it's okay to sit through a little bit of drawdown. You're not looking to put yourself under like, 50, 60, 70 pips, but 20 pips, 30 pips, that's okay. And here you see if you would have entered, you would have had about 20 pips or so drawdown as well. Now, this is why me personally, I always wait for the confirmation of bullish price action coming off of the level that I'm expecting support to be found at, okay, for buying scenarios. So in this particular situation, you can see we break up, retest, right? I would have never bought here, right? I would have just waited, let it do its thing, and then I would have got in either on this initial push up. So look what we have here. Market trades down. Boom. Explosive push up, making a higher high. Then we trade right back down here into these down candles, which is an ICT bullish order block. So I would have entered, or would have taken my first position at least, off of this level. Now the reason I would have done that is because I've already had the daily break in market structure way back here. Then I had the market come into daily support, come all the way up, break market structure on an hourly basis, prove to me twice here that it's holding as support, and then I get a big bullish hourly candle. So immediately on this candle's close, so if we're trading and it looks like this, immediately my eye goes to these down candles. I mark out the high, I mark out the open, and I mark out the 50% level. And then there is where I look for my trade. So this would have been my first position. And now let's talk about the stop of this. My stop loss would have had to go below this previous low because we've already broken above it. So if we're bullish, we should not break below this low. Now my stop loss is 23 pips, but I've got the confirmation. Look at the expansion that happens after. Boom. Where are we targeting? Above this high. So this right here, so trade would have ended on this spike up. So that spike up would have more than likely cleared out your take profit. So we risked roughly 25 to 26 pips for a potential profit of 80 pips, right? And it's 86, but I'm using 80 just to round it to an even number. 80 pips, but the full move was about 100 pips. Okay, I never look to catch the full thing. I'm always just looking to enter right at the level. So this is my target. I would have entered right here, or I would have entered a few pips before that. That's why I used 80 pips. So 80 pips would have been like 31.10, and I would have exited right around there. Okay, so 80 pips for 20 pip risk. That's 4 to 1 reward to risk. Okay, And we've already had everything in place previously showing and proving to us that the market should go higher. All right, so we know buy opportunity 1 for swing traders, potential buy opportunity 2 and 3 for swing traders, and then this one would be the first intraday buy opportunity. And me as a trader, I'm primarily a day trader. I don't really look to hold trades long term. So I'm mainly just looking for those moves that will, transpire over a session or the course of a day. So if I put the daily lines on here, you can see that this is the start of October 3rd. And right here is the end of October 3rd. So this is October 4th. Sorry. Right here we've got October 4th, then we've got October 5th here. So October 2nd, 3rd, 4th, I wouldn't have done anything yet. I would have just been sitting, waiting. Then we get the push up. We're holding, bam, right here. We got the confirmation. Entry number 1. So I'm going to make this one, because it would have been where I would have entered, I'm going to make this one purple. So it'll be a different color, because red are going to be swing trade entries. Purple will be potential intraday opportunities. Okay, so then notice what happens after running the high. Rejection. Where do we stop? ICT bullish order block. Now I also want to counsel you to start using your fibs a bit on the breaks of market structure. Pull your fib from this low to this high, because this is the move that broke out of market structure, this high and this high. We come all the way back down, stop on a dime at 79%. Right there we push up. So second opportunity would have been here, and we're going to make this one purple. Reasoning for that would have been alignment with the 79% retracement level and also the ICT bullish order block here. If you missed it on this trade here, notice how it gives you another opportunity. The market pushes up, breaking above this high. So now you've got what? A confirmed ICT bullish order block for this down candle. Close above it. This would be your next entry right here on this down candle. And your target would have either been above this high, or it would have just been a scalping position, meaning you would have just gotten out after 10, maybe 15 pips, something like that. So on this retest, your stop has to go where? Below this low. So you're risking about 30 pips. The market gives you roughly about 40 to 50 pips or so before having another round of selling. So my question is, if you were a buyer here on this down candle, would you have closed it on this breakdown because it would have scared you out of the position? And this is where you really develop as a trader, right? You have to keep in mind the context of the market and what the overall direction is. Because there are plenty candles, there's 24 candles in one day. So you'll see, or 24 1-hour candles in one day. So there's multiple different candles to make you think different things, right? Especially if you're watching the chart on an intraday basis. So if you buy it here, you get a little bit of profit. So if you don't close partials, which I highly recommend everyone do, make sure you're always closing partial profits. And if you haven't seen my video on partial profits, I'll actually link it above this video. Just click the little eye icon and you can watch it. But taking partial profits is critical to developing as a trader, because you have to absolutely make sure that you're paying yourself and you're not constantly losing money, for example. So the move back down here, notice what happens. It does not break this low. So even if you were a buyer here and you didn't take partials, you would have had to sit through this little bit of drawdown. So again, we would have bought it here. We would have sat through 30 pips worth of drawdown. Sometimes you're going to have drawdown, guys. You just have to expected and anticipated. It comes with trading. So this would have been your next opportunity to be a buyer. And you're probably thinking, well, how would I have known to buy it here? Right? How would I have known that it wasn't going to run below this low? Again, let's take out our fib. Draw it from the same swing that we had previously. Low to the high. First opportunity is here at the 79% retracement level. Get a little bit of bullishness off of that. Come back down one more time. While we're within the 61.8 to 79% levels, this is your opportunity to be a buyer. So within this small little consolidation, this is your opportunity to be a buyer. Where are your targets? First target would be above what? The next swing high. So you got a swing high here. So if you're a buyer here, you're targeting this high, right? If you're still long here, so if you still are in your position that's in this down candle here, your stop loss is below this low, so you never got hit on this unless you got afraid and closed the order on your own. Okay, which shouldn't have happened because you should always keep in mind the overall structure of the market. We're bullish. Okay, so the market comes down into our levels again, 61.8 to 79. Anywhere in here is a valid buy. Look at what happens here. Down candle, bullish candle, down candle, explosive move. Down candle, bullish candle, down candle, explosive move. Notice how this low formed here and this low formed here is pretty much the same thing, right? So you've got a down candle before this bullish candle, which confirms this down candle as a bullish order block. So if you're not someone who really draws your fibs, or that wouldn't have been the tool you would have used, you also have an ICT bullish order block here. So you don't have to buy it at the low. Then you get the bullish candle, you buy it on the retest of the order block. Look at the reaction. So watch what happens here. Stop loss goes below this low, 19 pip stop. First target is this swing high, 60 pips. Next target is this swing high, 80 pips for 20 pip risk. So right there you've seen 1, 2, 3 swing trade position entries, and then 1, 2, 3, 4, 5 intraday opportunities for a potential buy. So this is why it's so important to keep the daily levels on your charts, because notice how many candles we have here, right? This is between 3 days and we've got all these candles in here, right? You have to work with a higher time frame and mark those levels out, because whatever happens on a lower time frame is going to be reflecting what's happening on a higher time frame. Okay? Everything with price is fractal. So this is a big point. Price is fractal, meaning what happens on a daily will be able to be transposed on a 4-hour, 1-hour, 15-minute, 5-minute. It just looks a different way, meaning there's way more candles. So you're looking at a lot more price action. But the overall concepts, ICT bullish order blocks, swing highs, swing lows, directional bias, all that stuff applies to not just the higher time frames such as the daily, weekly, and monthly, but also the 4-hour, the 1-hour, the 15-minute, the 5-minute, and hell, even the 1-minute, right? So all of that applies. So price is fractal. Do not forget that, because what that means is price is always a reflection of the higher time frames if you're on a lower time frame. So if you're on a lower time frame, price will be reflecting what's going on with the higher time frame. So you clearly see the reaction off the bullish order block, and then from there we're able to scout our entry opportunities. Also guys, if you want to learn from me directly and really work with me on a daily basis and see how I'm viewing the charts real time, get my trade signals, all that stuff, check out my analysis every day and every week, then my best suggestion to you would be to join the premium group, because that's where I do all that stuff. I primarily keep YouTube for like free material. I do some educational stuff, and I do upload my analysis of what I'm expecting for the market each week to YouTube on Sunday. But for those of you that do want signals and really want to learn how to become a trader, I would suggest joining my premium group, and the link for that will be the first link in the description. Hopefully this video was pretty insightful to you guys and you got some value from it. If you have any questions about anything regarding this video, just post them below right in the comments, and I'll see you guys in the next video.
After this track I might need me some lozenges. I ain't about to go soft, this rapping shit lately been pissing me off. Guess these words are kinda just at the tip of my tongue, but I'm still young and I hope I find the rhymes that'll live through time before that fat lady has sung. Cause when I'm inside this booth, feels like I rule the world. But I'll hop off my horse, hop in your Porsche, give it